Let's continue with our discussion of The Corporation in the 21st Century by Sir John Kay. Today is the seventh part of our interpretation. In this section, we analyze what capital really means in today's world. The word capital often sparks strong reactions because it historically carries a class implication. Those with capital and those without seem to belong to entirely distinct groups. Indeed, that was the reality in the 19th century. To open a factory, the decisive factors were not people, but machines, buildings, and raw materials, which required money to acquire. That money is what we called capital. In that sense, capital was a factor of production. If you owned the building and machinery, you automatically controlled the factory. Even if you hired a professional manager. The manager reported to you, and you could remove them at will. You held that position purely because you had money. You were a capitalist. Thus, back then, capital carried three intertwined meanings. It was wealth, a production input, and a source of control over the company. This setup created a high barrier for ordinary people. No matter how capable you were, without capital you were just a worker. Meanwhile, a wealthy heir automatically became a capitalist and ran the factory. Workers had no hope of entry into the capitalist club. Unless they revolted. Many people still believe the world works this way. They view market economies as temporary, the influence of capitalists as instrumental, and expect their eventual downfall. But the reality has already changed. Today, capitalists no longer exist as they once did. Tiny businesses remain unaffected. If you open a milk tea shop in your village, you own the store, the machines, you pay fixed wages. And so wealth, productive inputs, and control rest with you. But for modern large, especially public, companies, wealth, production inputs, and control are now completely separate. First, wealth. Modern wealth takes three forms: bank deposits, government bonds, and stock holdings. For mega-rich people like Elon Musk, most of their wealth is held in company shares. Their net worth fluctuates daily and is largely unrealized for personal use, making net worth comparisons with factory workers a meaningless numbers game. Importantly, wealth, on paper, is neither a production factor nor a claim on control. Musk controls his companies because he founded them. When it comes to large public firms, institutions, pension funds, sovereign funds, hedge funds, own most of the stock. Their ultimate owners are countless retail investors. They cannot directly influence decisions. Directors in the boardroom are representatives, not owners. Once founders exit, professional managers run operations. For example, Microsoft's Satya Nadella originally came to the US on an H-1B visa, rising through the ranks. He now owns some stock. But control came before wealth. By that logic, is Nadella a capitalist? Let's turn to production inputs, i.e. assets or capital goods. Modern market value has largely decoupled from reported assets. When Sir John Kay wrote this book, Amazon's market capitalization exceeded $2 trillion, yet its on-balance sheet assets were only about $460 billion. Less than 1/4 of its market value. Assets are remnants of a manufacturing economy. Today, tangible assets, warehouses or data centers, are mostly rented, not owned. Software, goodwill, and brand value, far more critical, are undervalued or unmeasured. Collective knowledge, network effects, platform data. None appear on balance sheets. Inventory, payables, and similar line items fill out financial statements. But none reflect a company's real competitive edge. That's why market value diverges so sharply from book assets. Stock price reflects future income, not the historical value of produced resources. Because value comes from collective knowledge, not physical capital. You might argue, even if capital isn't central, a company still needs some capital. Bezos, after all, raised initial funding when he founded Amazon. In fact, Bezos and his family invested under $500,000. He later secured $8 million from a Silicon Valley VC, and raised $50 million at IPO. Compared to a $2 trillion market cap, that initial capital is trivial. He didn't need to purchase capital goods. They were rentable. Amazon rents warehouses from Prologis and leases servers from Equinix and Digital Realty. Its value lies in retail and cloud services, not in owning land or data centers. The same applies to airlines. Delta flies aircraft mostly leased from AerCap. Airlines focus on operations, not managing depreciation or aircraft ownership. This is the model of capital as a service, renting rather than owning. Infrastructure, land, energy, communications, often belongs to public or private entities, but companies simply use them without owning them. Social trust is another form of capital. Amazon sells first, pays suppliers later. It doesn't need to pre-purchase inventory. Capital as service has two benefits. It lowers barriers to entry and professional specialization. In reality, capital is no longer scarce. It serves you, nearly invisibly, like air. Economists Jonathan Haskell and Stian Westlake call this phenomenon capitalism without capital. In short, we now have what could be called capitalism without capitalists. Think about today's founders. Musk, Bezos, Zuckerberg. They own large shareholdings and control their firms, but their wealth wasn't built on initial capital investment. It came through control. Executives, e.g. Cook, Nadella, are managers. They don't truly own companies. Suppliers, warehouses, planes have physical assets, but exercise no influence. Even institutional shareholders are effectively temporary dealers, not capitalists. Banks and investors don't provide lasting capital in modern firms. IPOs nowadays are more about liquidity for early investors, not fresh capital for operations. Stocks trade among investors rather than become capital injection. Here, there's no traditional capitalist role. Reflecting further, the capitalist as an identity, wealth gatekeeper, becomes obsolete. Modern markets have decoupled wealth, productive inputs, and control, and divided each into many small tradable shares. Anyone can now partially become a capitalist, buying stock, renting out property, or holding some influence via employment. Yes, market capitalism can amplify inequality. Musk's wealth dwarfs most. But Sir John Kay reminds us that asset ownership has grown far more inclusive. Today, many professionals hold stocks or property, allowing asset-derived income. With mature capital markets and venture capital, rich inheritance matters less. VCs often back smart but cash-strapped entrepreneurs. If people with talent can't find opportunity without family wealth or connections, then the market you're in is broken. Modern mature markets increasingly enable people to follow their strengths and resources to be channeled rationally. So much so that asset ownership becomes incidental. A marvel of modern economy. That's it for today's content. Thank you for watching, and I'll see you in the next video.
If you feel there is value in this, please like, subscribe to this channel, and leave your thoughts or suggestions in the comments section. Let's grow together and read more good books.